Imagine having a wider range of choices for your retirement savings, but with a fair share of risk attached. This is exactly the bold new frontier that could soon be opening up for American workers' 401k plans. But here's where it gets controversial. The traditional, well-understood options might soon be joined by alternative assets like cryptocurrency, real estate, and private equity investments. Last month, President Donald Trump took a significant step by signing an executive order aimed at democratizing access to alternative assets for 401k investors. What does this mean in plain terms? Essentially, federal agencies are now tasked with dismantling the obstacles that have kept these alternative investments out of reach for most workers' company-sponsored retirement accounts. The goal is to allow employees to diversify their retirement portfolios beyond typical target date funds and ETFs, to possibly include assets like cryptocurrencies or private equity. For many, this idea might sound confusing or even a bit risky. But for younger investors, especially those just starting their retirement journey, these options might already feel familiar. Take Jakob Beschel, a graduate student who smiles knowingly when asked about crypto investments. Together with fellow finance student Kaustuba Pokarol, they lead the University of North Texas's Student Investment Group, managing over $1 million in real securities to sharpen their understanding of finance. People often ask me, "Do you invest in crypto?" Jakob shares. Pokarol explains that their group receives around 100 applications each semester, but only accepts about 10 members, highlighting the high interest in investment among students. They regularly face questions about how to navigate markets, with many inquiries focused on cryptocurrencies. This isn't surprising since social media and news outlets frequently spotlight stories of traders striking it rich with Bitcoin and other digital coins. Pokarol points out an important trend. Our generation seems driven by a fear of missing out. Many dive into investments after watching just one or two YouTube videos, convinced they've uncovered the perfect strategy. Despite this buzz, both students take a more cautious approach, preferring stable, traditional investments for their funds and advising peers to do the same. Experts in the financial industry echo this generational divide. Sam Borgi, a finance analyst at Investors Observer, notes that younger investors' approaches differ substantially from those of older generations. Borgi has been following the executive order closely and believes it will particularly appeal to younger workers opening their 401ks for the first time, since many are already somewhat familiar and perhaps comfortable with alternative assets like cryptocurrencies. People today are exploring new paths to build wealth long-term, Borgi explains, especially as real estate becomes less affordable. Alternatives like these might represent valuable opportunities. For those with many years ahead before retirement, these options could potentially mean substantial growth by the time their retirement arrives. However, Borgi also cautions about the significant risks. The potential for huge returns is real, but so is the volatility. It can be nerve-wracking, he states frankly. Pokarol and Beschel have witnessed this firsthand in their finance studies and investment group experiences. They've seen numerous cases where individuals lost substantial sums by going all in on cryptocurrency, only to be overshadowed by others who profited massively from volatile swings. Jacob sums it up well. You often hear the amazing success stories making millions, but the people who lose millions don't get the same spotlight. Usually, these scenarios involve discretionary funds or money investors can afford to lose. But here's the crucial difference. If these new retirement options become broadly available, we're talking about individuals' life savings, the money they hope to live on for decades. Given these high stakes, many financial advisors strongly recommend caution. Before making any drastic moves in their 401k investments, workers should consult with a financial expert, preferably a fiduciary who is legally obligated to act in their best interests. This personalized guidance is more important than ever, as the types of eligible investments for retirement accounts could expand into territories known for unpredictability and complexity. So, what do you think? Should Americans be granted the freedom to diversify their retirement savings into cryptocurrency and other alternatives, or does this open a dangerous door to financial insecurity? Is the promise of potentially greater returns worth the volatility and risk? Share your thoughts. Do you see this as a smart evolution of retirement planning or a risky gamble on the future?